أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقه قولي. Now, so as I have as I had earlier informed you, that is today we shall be having a review of the two lessons. So we have this lesson about the financial,
Teacher, wait, 2 minutes. Still, the students, they are enjoying the meeting.
but 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 I have only 40 minutes. I sent the message, right? I sent the message and I informed the student the lesson will start at 8, right?
Okay.
So 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 I cannot really wait because students need to manage their time because I also have some other issues to do and we only have less than 30 minutes. So we need to train. We need to train our students to manage time. I had already said that the lesson will start at 8, and now if you look at your time, if you look at your watch, what's the time now? It's 8:08. So I'm just right to. So ala kulli hal, what I was just saying is that we've covered like 6 chapters in this course, business accounting, and the other time you did your CAT, the continuous assessment test, and most of the students they scored some good marks. Okay, now the final exam will cover only how many chapters? We'll cover only 2 chapters. This chapter, which is the financial statement analysis, and it will also cover the financial ratios. So I'll just be reviewing quickly because we had already covered actually, but I was just instructed to help the student because there are some students who requested for this lesson because personally I had already finished this lesson, but because of the request of some students, I was told that some students they just want an overview of the course and what is going to be in the final exam. So, like I've said, in your exam, you will find the financial statement analysis. Now, when you're talking about the financial statement analysis, if you look at these slides, number one, of course, you have to know what is financial statement analysis. So when you're talking about financial statement analysis, it is the process of analyzing a company's financial statements. And remember, in our previous lessons, we talked about the financial statements. We said number one, there are 3 most important financial statements in any business, in any organization. So number one, we said there is the balance sheet. Number two, we said there is the income statement. Then lastly, we said there is the cash flow statement. So when you are talking about financial statement analysis, we are basically analyzing these statements so that at least we can be able to do what? We can be able to make informed decisions. For example, I'm an investor and I want to invest in your company. So before I invest in your company, I will have to ask for your financial statements and I will have to analyze those statements. So those statements, once I analyze, it will give me the what? It will give me the information that will enable me to make the decision. Now, so when we were talking about this is what I was talking about, the types of financial statements that are always analyzed. So these are the 3 basic financial statements that we always analyze. So we have the balance sheet, we have the income statement, and we have the cash flow statement. So we normally do what? We normally analyze these three financial statements so that at least we can be in a position to make an informed decision. So I'll not explain a lot because already we had covered these financial statements. And there are very many reasons why is analyzing these statements important. Somebody can ask, why do we need to analyze this financial statement? So number one, investment decision. Today I want to invest, for example, at Dahabshil Bank, but I cannot invest without knowing the financial strength and the growth potential of Dahabshil. So before I put my money inside their basket, I need to analyze their statement. Credit evaluation, banks. So before the banks give you money, they will always ask for your financial statement. So they will analyze the financial statement to see if you'll be in a position to do what? To pay them back their money. Because I don't want to give you money, then later on, you don't pay me back my money. So this is what is known as credit evaluation. Management decisions. So company management uses financial analysis to make informed strategic and operational decisions, such as cost-cutting measures, expanding product lines, or restructuring debts. So when you're talking about management decisions, remember in strategic management, when we were talking about strategic decisions. So sometimes maybe as an organization or as a company or a business, you want to expand. You want to open a new branch, but you cannot do that unless you analyze your financial statements to see if you have the strength and if you have the capacity to expand. So for example, you want to cut costs in your organization. You need to analyze those financial statements. You need to know the revenues, what is coming in. You need to know what are the expenses. You need to know where you are using a lot of money. So it's very important. Then also performance assessment. These financial statements, they help us to assess the performance. We are now in 2025. So even last year, we can easily analyze these statements in 2025 and we can compare it with our performance in 2024. And from that, we can easily know, are we making a positive progress or we are making a negative or we are not growing. So we can compare performance and we can make important decisions. Now, also, analyzing financial statement is a regulatory compliance. Governments in many countries, they always need you to do what? To submit and present to them the what? This financial statement is very important. Then it's also a form of stakeholder communication. Remember, as an organization, you have a lot of stakeholders. You have internal stakeholders, you have external stakeholders, So one way of communicating with both of them is through the analysis of the financial statements and giving them what? And giving them a detailed report. Now, we have types of financial analysis, but we shall not analyze all this. So let me go to, this is the most important part. The types of financial ratios in your business or in your organization. So these, like most of these ratios, you'll find it in your exams. So you can be asked to calculate a given ratio. Maybe it can be a liquidity ratio. Maybe it can be a profitability ratio. You can be asked to calculate, and from the calculation, you'll be required maybe to do what? To do a thorough analysis, Now, when you're talking about the types of ratio, we have many ratios in an organization. So number one, we have the liquidity ratio. Number two, we have the profitability ratios. Number three, we have the solvency ratios. We have the turnover ratios, and we have the earning ratios. So these are the common. We have more than this, but these are the common types of ratios that we normally calculate. And through the After calculating, when we get after calculating, then the number that we get can really help us to make decisions. Now, let us start with the liquidity ratios quickly because it's just a review. Now, what is liquidity? When you're talking about liquidity ratios, so liquidity ratios are financial metrics used to do what? Used to evaluate a company's ability to meet its short-term obligation with its most liquid assets. So that is in brief the definition of what? That is in brief the definition of liquidity ratio. So liquidity ratio basically answers the question, are we as an organization in a position to meet our short-term obligation with our most liquid assets? When we are talking about our most liquid assets, we are talking about cash. We are talking maybe about some of the inventories that we are having in our company. So are we in a position to meet our short-term obligations? If the answer is yes, then we are good to go. But if the answer is no, then why are we operating if we cannot meet our basic short-term obligations? So it's better we just close our business, our company, because we cannot meet the petty obligations. Now, when you're talking about the liquidity ratios, so what are the importance? What are the importance of the liquidity ratio? Number one, short-term financial health. Liquidity ratios provide insights into a company's ability to satisfy short-term. The keyword is short-term debts, helping creditors and investors assess the risk of insolvency. So through this liquidity ratio, we get information. We can easily know that company A can be able to meet its short-term obligation. Company B cannot be able to meet its short-term liabilities or obligations. Then creditworthiness. Lenders, in this case, when we are talking about lenders, we are talking about banks because they are the ones who normally lend people money. So lenders are keenly interested in liquidity metrics when evaluating a company's creditworthiness. So a company with strong liquidity ratio may obtain loans more easily. So if you go, for example, to the Dahabshil Bank, they will ask you for your balance sheet. So from your balance sheet, they will be very keen to see the what? They'll be very keen to see your current assets and your current liabilities. So if your current assets are more than your current liabilities, then they can easily give you money because they know that you are in a position to do what? To pay your short-term obligation. But vice versa, if, for example, your current liabilities are more than the current assets, that is very alarming. It is danger. It shows that you don't have enough cash. It shows that your business is not growing, it's collapsing. Then operational efficiency. High liquidity ratios can indicate effective working capital management, and optimal inventory levels, suggesting the company can sustain operation and growth. When you are talking about operational efficiency, remember in an organization, we normally have strategic operation, we have the tactical activities, then we have the operational activities. When you are talking about operational activities, these are the day-to-day activities you are doing. Like when you are buying on a daily basis, when you are selling, all those are operational activities. So through the liquidity ratio, we can easily know if we are efficient in our operational activities. Now, investment decision. Investors use liquidity ratios to determine the financial stability of a company, which helps in making informed investment choice. So if I want to invest in your company, then I will ask you for your statements and I will calculate the liquidity ratio. If the liquidity ratio is high, then it basically means you can sustain your business. It means that you are stable. So, and in that case, it basically means we can do what? I can invest in your company. Number 5, financial planning. So, analyzing liquidity ratios aids management in making strategic decisions regarding cash flow management, including investments or cost-cutting measures. So, the liquidity ratios can either guide us to cut costs or it can also guide us to invest more. So that is why the liquidity ratio is very important. Now, when we're talking about the liquidity ratios, from our previous lessons, I said that we have 1, 2, 3, 4, 5 of them. So these are the liquidity ratio. So the first one is normally known as the quick ratio or the acid test ratio. And remember, in all these ratios, we just have a formula. So you just apply the formula, and from the formula, you'll just be given the figures. For example, in the case of quick ratio or acid test ratio, you will be given the current asset, you will be given the inventory, and you will be given the current liabilities. So you just have to apply the formula. Once you apply the formula, then you also have to analyze. The analysis is in this white. So for example, a quick ratio of 1, for example, if you calculate and you get 1, means that for every dollar of current liabilities, the company has $1 of liquid assets, current asset minus inventories. This suggests that the company can meet its short-term obligation without relying on the sale of inventory. So you have to actually be in a position to know the meaning of the numbers that you get. Now, the same thing applies to cash ratio. You just have to know the formula. And from the formula, you'll be given in the exam, you'll just be given all the items. For example, the cash ratio. I will give you the cash and cash equivalents. You'll also be given the current liabilities. So you'll just be applying the formula, then get the answer, then analyze the answer. The same thing applies to the operating cash flow ratio. So you will be given in the exam the operating cash flow and you will be given the current liabilities. So you will just take the operating cash flow, divide by the current liabilities. The same thing with the working capital ratio. It is current assets minus current liabilities, as easy as that. So you just take the current assets and the current liabilities. Then you get the answer. If the answer is positive, it means Fabia wa Neema, it's okay for us. We have more assets than liabilities. But if you calculate and you get the working capital, if the working capital is negative, it means we are in danger. It means that we cannot sustain our obligation. It means we cannot pay our creditors. And that is very, very dangerous. Now, so khulasatul qawl, the liquidity ratios are vital tools for evaluating a company's ability to meet short-term obligations. So the key word is short-term. Now, number 2, we have the profitability ratios. So what are they, the profitability ratios? So the profitability ratios are financial metrics that assess a company's ability to do what? To generate profit relative to its revenue, operating costs, balance sheet assets, or equity. These ratios are vital for measuring a company's overall financial performance and are commonly used by investors, analysts, and management to evaluate operational efficiency and profitability. So when we are talking about profitability ratios, just from the word profit, al-arbah. So these profitability ratios, they are basically guiding us, helping us to know, is the business getting profit or loss? That is full stop. Are we getting enough more of the revenues? If the answer is yes, then that is a good business. Because today you don't want to invest in a business that is making losses. You cannot put your money in what? You cannot put your money in a business that is getting a loss. So the profitability ratios will help you to know the capacity of a business in generating profits. Some businesses, they generate 2 times profit. Some business, they generate 3 times profit. Some business, they generate 5 times profit. So the level of generation is very high. And that is where you want to find yourself. That is where you want to put your money. Now, what is the importance of the profitability ratios? So number one, investment assessment. So investors use profitability ratios to determine a company's financial health and its efficiency in generating profit. Are we efficient? Can we sustain the generation of our profits in the long term? If the answer is yes, then we can easily invest in your business, you know. Number two is performance evaluation. Management can evaluate operational performance, identify areas for improvement and growth based on profitability metrics. It can guide us to identify what are our strengths, we capitalize on the strength. And we can easily know what are our weaknesses so that we find ways of improving, we find ways of enhancing. Comparative analysis, we can compare the profit ratio of our company in 2025, compare it to 2024, compare it to 2023, ila ghairi dhalik. So we can easily know the trend. Is it an upward trend or a downward trend? Then financial planning, it can help us to efficiently and effectively allocate resources where we hope that it will generate a lot of profit. Because as a business, you don't want to put money in a branch that is not generating money. For example, if it is Dahabshil Bank, maybe there is a branch in Garowe or there is a branch in Berbera. It's not doing well. Why should we continue putting our money there? No, because they are not giving us enough profit. But there is this branch maybe in Hergesa or Mogadishu, it is giving us a lot of money. So we need to invest, we need to put a lot of money there, you know. Now, operational efficiency, identifying trends in profitability can help pinpoint. Pinpoint means it can help us to know the areas. Pinpoint inefficiency. Inefficiency means areas that are not doing well or successful strategy within the company. So it can help us to know the positive sides of our organization and also the negative sides of our organization. Now, again, we have different types of profitability ratios. Number one, we have the gross profit margin, we have the operating profit margin, we have the net profit margin, we have the return on assets, and we have the return on equity. Again here, what is happening, for example, with the gross profit margin? We have the formula. The formula is gross profit divided by revenue times 100. So you will be given the figures. So you just have to take the figures, calculate, get the final figure, and analyze the figure. Operating profit margin also, you have the formula. which is operating profit divided by revenue times 100. You get the answer, and you should be in a position to analyze the answer. The same thing with net profit margin, which is the formula is net profit divided by revenue times 100. All these figures, you just get it from the financial statement. You just extract, put this here, calculate, get the answer. Now we have the return on assets. So the formula for the return on assets is net income plus the total asset times 100. So basically the return on asset is helping us to know the profit that we are generating from our assets. Like, are we making a lot of money from our asset? For example, if you're having a transport, if you're having a taxi business, is this car, are you getting a lot of money every day from your taxi business? If the answer is yes, it means, mashallah, you are using your assets efficiently. But if every day you have to repair the car, the car is not working, so the car is full of problem, so the return on asset will be very low. You'll not be gaining a lot. Just the same way as your laptop. You have a laptop with you. Are you generating any money from your laptop? There are some people who are very good. They use this laptop to sell, to buy things online. So they are using this asset effectively to generate income, to generate profit. While some people, students, they just have the laptop, they're just in social media, in YouTube, watching movies. So you are having your asset, but your asset is not really helping you at all, Okay. The return on equity. So when you're talking about the return on equity, the formula is net income divided by shareholders' equity times 100. So when you're talking about the net income, when you're talking about the return on equity, equity is basically the amount of money the shareholders have invested in the business. You have shares in companies, mathalan. So you invest, you have, for example, you have shares in Dahabshil Bank or Telesom, you have shares with them. But at the end of the year, mathalan, what do you get from those shares? Are the prices of the shares increasing? If the prices of the shares is increasing, it means that, mashallah, it means you have invested in the right business. You've put your money in the right business. But sometimes you put your money in business and the share prices is going down. If the share price is going down in the stock market, it means that that company is losing value. And the earlier you take your money from the business, the better. So you really have to be very careful. So again, you can easily get the figure and it can really help you. Now, ala kulli hal, khulasatul qawl, profitability ratios are essential tools for assessing a company's financial performance. That is the khulasatul qawl. Okay? So that is the khulasatul qawl. So profitability ratios are essential tools for assessing a company's financial performance. Each ratio provides a unique insight. There are 5, 6 ratios. So each ratio will give you a different dimension, Okay. Then number 3, we have the solvency ratio. Solvency. So what are they? So solvency ratios are financial metrics that assess a company's ability to meet its long-term debt obligation. So it is the opposite of liquidity ratio. Liquidity ratio, it basically assesses the ability of a company to meet its short-term. But in this case, the solvency ratio, it assesses the ability of a company to meet its long-term obligation. Now, so what are they? So we have different types of the solvency ratio. So number one, we have the debt to equity, we have the debt ratio, we have the interest coverage ratio, the equity ratio, the financial leverage ratio. So for each one of these, again, you have a specific formula. That is, for example, the debt to equity. The formula is the total debt divided by our shareholders' equity. Then we also have the debt ratio, which is the total debt divided by total assets. So it helps us to know, do we have enough assets to pay our long-term debts? So that is another important thing that can really do what can really help us. Okay. We also have the interest coverage ratio, because sometimes when you go to the banks, they give you what? They give you the loans with the interest. And sometimes, of course, in Islam, the interest is haram, So most of the Islamic banks, they don't operate with the riba, the interest, but this is for the conventional banks. When you take a loan from them, you have to pay it with an interest. So the interest coverage ratio, it is a ratio that basically helps us to know, are you as a business, you are earning, so it is just comparing your earning to the interest ratio of your loans. Like, will you be in a position to pay back your loan based on the interest rate every year? That is compared to your earning. That is basically the interest coverage ratio. Then we have the equity ratio. So the equity ratio formula is the total equity divided by the total assets, Now, when you're talking about the total equity and the total assets, the higher the better. If you get a higher figure, it means that, so if you get a higher figure, it means that your business is being financed by your own money. You are not borrowing money outside. You are financing. You are independent. You can sustain yourself. But if it is low, it basically means your business is depending a lot on external finance, which is very dangerous. Then you have the leverage ratio, total assets minus the total equity. Okay. Now that is the end of our revision. Now, as I take the attendance, please, if you have any question, you can ask. We have like 20, we have not 20, we have like 2 minutes remaining or 3. So if you have any question, you can ask, please. Any question? Yes, please.
Assalamu alaikum, Teacher Marjan.
Wa alaikum assalam wa rahmatullahi wa barakatuh. Welcome.
Thank you, teacher. I will ask you 2 questions. The first question is,
Yes.
when we'll do for the final exam? And the second question is there any change for the chapters you will told us for the before?
Okay,
The
thank you for
chapters of
your Okay, thank you for your question. So there is no change at all. So your exams will just cover, we just have 2 chapters. That is chapter 5 and 6. So this chapter here, financial analysis, and the other one is the financial statements.
Mm-hmm.
Then for the issue of the exam, frankly speaking, I'm not sure about when the exam will be. So of course, you all know there were some issues, and I guess they are trying to solve it. So I don't want to be part of that, but I believe the management will communicate with all the students about the debt, So I'm not sure. I'm not sure about the debt, but from my part, I have finished the course. So, and I have even submitted the final exam. So I think maybe you can just wait for the communication from their side, inshallah.
Thank you.
Thank you. Welcome. Is there any other question, please? Any other question? I'm trying to take the attendance. Can somebody help me take the attendance? Take the names. My camera is having a problem. So if somebody has a good camera there, you can share with me the. I'm trying to take a picture, but it's not. It's not what. Please, is there any other question? Any question? We have 1 minute remaining. So I have tried to capture some pictures. So that's the end. Hopefully, I don't know if we'll meet again in another course. That's the end of our course, and hope once all the issues have been fixed, we can just continue with our classes, inshallah, because that is the most important thing for you as a student. You need to see the classes going on. So I think they are working on all the issues, and soon and very soon, maybe the exam timetable will be generated. The classes will continue as it was before, inshallah. Okay. So if there is no question, Jazakumullahu khair. I'll always be available online. If you have any question related to the lesson, if anything is not clear before the exam, you can ask me, inshallah. Thank you very much.
Okay, you're welcome. You're welcome.
Thank you.